As the name suggests, systemic risk is basically the risk that an entire system collapses after the fall of one market participant. Let's refer to the banking system and assume that in a certain country there are 55 banks. 5 big banks with a market share of 10% each, and 50 much smaller banks with a market share of 1% each. If a bank fails, we can quickly identify 2 risk factors. 1. The other banks which did business with the failed bank will suffer losses. 2. Depositors might panic and stop trusting banks in general, thus deciding to take their money out. In our scenario, if only one of the 1% market share banks falls, the banking system will most likely survive. Yes, some banks will lose money and some depositors might panic, but most likely not enough to push the system over the edge. However, if one of the 5–10% banks goes bankrupt, it's quite likely that the banking system as a whole will collapse. Not certain, but definitely likely. These big banks tend to be considered systemically important or too big to fail, and as such, governments will do whatever they can to ensure they survive. After the Great Recession, for example, governments rescued banks, but also insurance companies such as AIG or auto companies such as General Motors. One important question arises. Doesn't the special treatment systemically important institutions receive lead to moral hazard situations?